Hi, and thanks for watching. Today's January 22nd, 2016, and this is an interim portfolio update. The purpose of this video today is to briefly discuss some of the things we see occurring in the financial markets and to let you know what we're doing on our end to protect your portfolios. By and large, we're seeing a lot of negative sentiment around the market right now. Some of the downside action that we saw pick up in mid-December of 2015 has carried right over into the beginning of 2016. We have a lot of dark clouds hanging over the market right now. A couple of those would be some of the things we're seeing occur in China with the slowing of their economy. While we don't invest directly in Chinese companies, it is a concern for a lot of larger U.S. national companies that derive a lot of their profits from Europe and in particular areas in Asia and China specifically. So that's something to keep an eye on. We will continue to avoid those areas as far as future investments we will make, but nevertheless this has been a concern for a lot of the larger companies based here in the United States. A second thing we see affecting the economy and the markets in a negative way is the giant slide we've seen in oil prices. While it is a good thing for the consumer, as we've seen the national gasoline average per gallon come down below $2 for the first time since early 2007 and into 2008, by and large it's not good for companies in the energy sector. And some of those are some of the largest companies in both the S&P 100 and S&P 500 stock indexes. So they've been putting a lot of downward pressure on the indexes, and that's definitely contributed to some of the decline that we've seen. Another thing we see as a concern is slowing profits coming out of these U.S. companies that are reporting their earnings. It will take some time before we can decipher if this is the beginning of a new trend that's heading in the wrong direction, or maybe just an outlier from a bad quarter or a bad month. So we will keep a close eye on that as we move forward. But that is something that is very important, and we want to wait and see how this next quarterly earnings reports will come out as we get through the next couple weeks here and into earnings season. On our end, we see a lot of risks right now that have really become prevalent in the marketplace, and there's not a lot of opportunity for reward at the current time. As a result, we have scaled back a lot of our exposure to risk assets in the markets. By risk assets, we mean our growth assets, different stocks and mutual funds that concentrate purely on growth. Right now, we think it makes more sense to have higher levels of cash in the portfolio, to act as a stabilizer, if you will, and to try to avoid some of this downside action that's been happening. We did take that action about 10 days ago in the portfolios that we manage on your behalf, and so far it's been a good move. We will continue to maintain the fixed income investments in our portfolio because fixed income is seen as a safe haven. So when markets get crazy, a lot of money tends to flow into fixed income, and by fixed income we mean bonds and treasuries and fixed income paying investments like that. So we will continue to put money to work in those areas as they've actually seen an uptrend, a sustainable uptrend start to develop as the rest of the market has moved further south. So that's what we're doing on our end in terms of protecting your money, protecting your portfolios. We're reducing our exposure to risk assets. We're increasing our exposure to safety like fixed income. And again, there is some individual pieces in the portfolio that we have a long-term belief on, some individual companies that we will continue to hold, some different areas of the market that we will continue to remain invested in, like healthcare, which tends to be a very defensive sector, which tends to do fairly well when markets get a little bit choppy. So we will maintain our exposure in those areas, but those are very small pieces of the portfolio. And like I said, right now, we do feel that cash is king. We are very nimble, so we are able to turn on a dime if this market decides it wants to head in another direction. But right now, based on our research, based on our analysis, we see a lot more bad data than good at this point, and we think it's the prudent move to scale back some of our risk a little bit, take some money off the table, and allow this thing to wash out. Once that runs its course, we'll be in a great position to re-enter the markets at better pricing and take advantage of the market rising back up. As always, if you have any questions about anything I'm discussing in this portfolio, please feel free to give me a call or send us an email. And if you know anybody out there that's not getting the type of portfolio service and advice that they need, or maybe they're not sure what their strategy is, as always, have them give us a call. We'd be happy to chat. There's never a cost for a conversation, and we're always looking to help other people as well. Thanks for watching, and I hope to see you soon.